Let's take a closer look at the fixed income space now with David Alao. He's an analyst at Stanbic IBTC Asset Management and joins us from the trading floor on that end. David, thanks so much for joining us this morning. Well, yields on Treasury bills fell at last week's fortnightly auction. Let's take a look at your view on whether or not we're looking at a sustainable trend here.
Okay, we think that this week yields are going to decline slightly in the short end, at the short end of the curve, and that's driven by two things largely. Number one, we're expecting FAC inflows of about 75 billion to hit the system. That usually drives down yields because it just creates liquidity in the system. Then secondly, also we're expecting inflation to print sometime this week as well. I think it's tomorrow. With that, we're expecting inflation to decline from 9.5 to 9.1. You know, that should create like a short-term rally also at the short end of the curve. So largely we think from local players, particularly the banks and pension funds and local asset managers, we're going to see yields decline throughout the week. But then, as you know, you would find from time to time that the CBN will come through the market to mop up using OMO bills, and those usually just distort the belly of the curve, and usually those will print at way off levels, say 12 and a half, you know, and then yield starts trending back up somewhat. So we think that yields would trend downwards initially towards the middle of the week, and then from there on we think probably on Thursday we should see a normal auction, and then yields would go back up. From the foreign investors, we think that lately there's been a bit of a risk of sort of going on in the market, and that's because yields just been trending downwards. You know, when yields are slightly higher, we think that they would put on some trades, you know, put on some risk, and also carry trades as well.
Let's take a look at who's been active in this market, where the activity is coming through from, David, because we know that pension fund managers are key players within this space. Many of them however, have recently increased their allocation to equities. Do you think that the relatively lower yields available at the moment will have a significant enough bearing on how they allocate to bonds moving forward?
Right. At the beginning of the year, I think the allocation of pension fund managers to equities was somewhere around 5%, 7% of the global assets, and towards end of first quarter, I think it went up to somewhere about 15, 17%. So already we've seen them allocate about 10% or 12% in this market already. I think that we should see them increase the allocation, but bear in mind the maximum they can go to at the moment is still 25%. So to my mind, I don't think they're going to reach the upper limits. I think somewhat they'll probably be around 20%, 22% of total assets in equities. But beyond that, these guys always receive new inflows into their books. So we think that they would still allocate towards fixed income. At the moment, yes, they're shifting or switching from fixed income to equities, but I think that towards the middle of the year or towards the end of the year, we're going to still see increased allocation to fixed income regardless, you know, and I think that also should put pressure on yields, and yields should decline somewhat.
Well, we've had Nigerian bonds included in the JP Morgan bond index last year. Nigerian bonds added to the Barclays bond index at the end of March this year. But the impact of Nigeria's inclusion on that Barclays bond index has certainly been less dramatic. Let's take a look at the kind of impact it has had on foreign investment flows and sentiment around Nigeria.
Right. Three factors affected you know, when JP Morgan's index was included in Nigeria. Number one, the first one, they were, you know, way higher yields compared to now. So yields were very attractive at 16, 17, 18%, you know. And then you had hedge funds who were already allocated to Nigeria anyway, who were already investing in Nigeria. So they took advantage of those opportunities and they drove yields downwards. Also, local investors also, you know, increased their allocations, you know, went overweight and obviously took advantage of the opportunities, knowing that foreign investors were going to come through the market. You know, then by the time the fund managers who track the JP Morgan index sorted out their custodian issues, setting up accounts locally, coming through the market, probably 6 months, and with that we saw them coming into the market when yields were around 13%, 12%, which was still relatively attractive, given that the highest yields in the JP Morgan index at the time was around 8%. So there was a 4%, 400 basis points or 500 basis points cushion or margin there. With the Barclays index, yields have already compressed, and we're seeing yields at 10.5 through 11.5. I really don't see these guys playing at the long end of the curve. I see them playing around the 5-year and the 7-year, which are trading around 10.8, where the Brazilian index is trading around about 8, 9. So the margins are much smaller. And then secondly, you have to bear in mind that these guys need about 6 months as well to sort of set up, their accounts locally as well. Thirdly, the Barclays index is a much smaller index compared to the JP Morgan index, so you're not going to get the same effect. In all, we think yields are going to trend downwards. We think these guys are here to stay. We think these guys are real money investors, and we think that yields generally will trend downwards, but don't expect the same impact you saw with the JP Morgan index.